Welcome back to Morning Trade Live. It's time to go inside out. I'm joined here in studio by the host of Fast Market, Tom White, who's standing by with some example trades. But we'd like to welcome in our guest, senior equity analyst from CFRA Research, Angelo Zino, is here to help us set up a really, really important earnings event for Broadcom. Angelo, thanks for taking the time and joining me here this morning. Happy Thursday, and looking forward to hearing your thoughts on Broadcom.
Yeah, so thanks for having me. And I'd say, Broadcom, I don't think there's anyone that doesn't think this is a company that's likely going to at least come in line with their numbers and guide at or above street expectations. This is a company that historically is very conservative in terms of providing their outlook. So, the bar is typically on the lower end of things in terms of their ability to beat it. So, we're looking for, the expectations out there for $1.57 in earnings and, $15 billion or so in revenue, implying top line growth of about 20%. Again, we think is achievable, and the guidance, implying a similar type of growth rate for the July quarter, we think has some upside to it. I will say this: I mean, the companies were running really hot into the numbers here. So, that being said, it has exceeded our target price at the moment. So we do think there's probably limited upside into the quarter unless they're able to show something outside of the actual numbers. So for instance, the last 2 quarters, they were able to demonstrate new customer wins, or at least new customer partnerships that are going to turn to new customer wins over the next 2 years that we think is going to drive upside to the numbers. So they need to talk something along the lines of greater customer momentum, greater AI revenue. We're looking for AI revenue of about $4.4 billion this quarter. So I think that'll be the key here on the quarter, less so the numbers itself.
Point well taken on sort of the conservative nature of this company, its prudence that it's shown in the past, but one can't ignore that it's found itself kind of front and center of this AI trade, which is anything but conservative in terms of volatility. This is a stock that had typically moved around, inside of 5%, let's say, around earnings pretty much into perpetuity until the last year and a half, where volatility's really, really picked up around these reports. Do you see that changing anytime soon? Are we watching kind of the reinventing of Broadcom, or a transition into a far more growth-oriented name?
I think those are fair points. I will say this: they do have 2 kind of core segments, right? You've got that infrastructure software business, which typically provides less volatility in terms of the revenue numbers. That has grown to about 45% of their revenue, much higher margins. They had the VMware acquisition about a year and a half ago. This is going to be actually, I believe, the first full quarter where you're not going to have to worry about year-over-year deviations in terms of the comps. So, I think the growth rates on that side of things start to decelerate. You're probably looking, about 23-24% here this quarter on the software side of things. The semi side will continue to be volatile. They've pointed to a served addressable market of about 60 to 90 billion as you go towards 2027. And I think that's important because when you look at their run rate right now, you're talking about, a semiconductor run rate of about 16 billion or so. So there is significant upside potential as they continue to ramp 3 existing custom silicon customers. Google's TPUs are by far the biggest component of Broadcom's custom silicon business, and then they've got these 4 new potential customers that could ramp here over the next 2 years. So there is significant upside. There is just incredible innovation going on across the semiconductor industry as we kind of move to this AI-driven environment. So maybe to your point, the volatility probably doesn't slow down when it comes to some of these chip makers out there. There's always going to be concerns about the level of compute, the supply-demand landscape, and what have you. So you're always gonna have that volatility. But I think that growth potential in semis can't be underestimated, and we do think that there, despite the valuation right now, there is considerable upside here over the next 2 to 3 years.
With that said then, and we can kind of compare to the entire sector as well, you did say maybe a little extended near term, but the growth rate, the product mix sets up for a nice, maybe longer term picture. You know, for those who are looking at this and know these names as AI trades, Nvidia, Dell, AMD, whatever it may be, including Broadcom, are they complements to each other, or are they direct competitors, or does it depend on who you're talking about?
It depends on who you're talking about, but you know, for the most part, they're frenemies in many respects. I mean, you've now seen an environment where Nvidia has kind of really transformed itself in their Blackwell offering to be more of a hardware-oriented offering, where they essentially kind of create the entire or design the entire rack. And as a result, most of these companies or more companies across the ecosystem are really kind of levered and tethered to Nvidia themselves. But when you think about a company like AMD versus Nvidia, they're AMD's, we think, going to have a potential blockbuster year in 2026 as they ramp up their rackable systems business. You've got Broadcom, which is probably the closest alternative right now to Nvidia, but they also sell into Nvidia in terms of their connectivity chips. So maybe to answer your question, these companies are both, and it does depend on who we're talking about. But for the most part, as far as the AI ecosystem goes, Nvidia continues to be the most important component there, and not far off from that, I'd say Broadcom is a second level to them.
Angelo, really appreciate you taking the time and setting this up for us. I know we're all excited to see ultimately what Broadcom has to say later on. Angelo Zino of CFRA Research. Let's welcome back in Tom White, host of Fast Market, here to take a look at a couple example trades on Broadcom.
Yep.
Now, like just said, with Angelo, I'm sure you heard, this is a stock that historically has moved about 5% around earnings. Its last 4 quarters, 12%, 10%, 24%, and 8%. Implied one-day move is just shy of 7. So the street is starting to give it some respect, but it's still not a total believer that this thing's going to move, big, the way that some of these other names have in this space.
Well, if you look at IV percentile rank, we always look at that going into earnings. It's kind of skewed right now due to the fact that we had so much uncertainty throughout the month of April after the tariffs were announced. The bar is really high in AVGO going into this earnings result. The option market's pricing in about a plus or minus $17 move in the shares, nearly 7% either way. The RSI on this one, Alex, 80 at the 80 level. Anything above 70 on the RSI is considered overbought. So
81.
Yeah, expectations and optimism going into this report really elevated on this name. This seems to be the new darling of the AI trade. It's taken that mantra from Nvidia at this point, but a lot of positivity going into this report. So I looked at a couple different strategies. The first one's a little bit more neutral to bearish. And Angelo mentioned the fact that, hey, in 2 to 3 years, they can see the growth rate reaccelerating. These are short-term trade examples that we're going to give you here. So I looked out at the June 6th weekly cycle. So just 1 day to expiration, really short-term positioning. We're going to sell something to the upside and neutral to bearish. Call vertical, where I'm going to sell that June 6th 270 call. And then I want to say risk defined going into earnings because, as you mentioned, last 4 quarters have just been spectacular moves either to the upside or downside. We're going to buy the 280 call. So sell the 270 call, buy the 280 call. $10 wide short, neutral to bearish. Call vertical, you're collecting roughly, I got about a $3 credit on there, maybe a little bit lower, maybe about $2.50 at this point, but that credit you collect is what you can make on it. But if you collect that $3 credit, it takes your break even up to $273. That's about 5% above the current share price of Broadcom of about $260. So you're giving yourself that cushion. You still have $700 in risk, but that's all the way above $280. So if you think the stock maybe goes lower, stays where it is, or even goes a little bit higher, but does not break that 273 break even, this takes advantage of the higher implied volatility, really short-term positioning, and the overbought levels on a technical basis.
Well, and the one thing to consider too is this is a lower beta stock than Nvidia, but it's hyper correlated to that trade. So it does perhaps for many make sense, or has made sense, I should say, in maybe a longer term position, maybe your stock shareholder or something that's a little bit more passively long. A trade like this, especially around earnings, it's not going to hedge you out of earnings, but it can be complementary with a little bit elevated volatility and also a little bit of a of a bearish tilt to it to perhaps reduce the brunt of that potential movement. Now you got something that's a little bit more outright bearish that you're looking at as well. So this one would be maybe a little bit more. You're saying, hey, this is overpriced based where it's at. Even if they say good numbers, maybe it's not going to be enough, and I see a little bit of downside.
Yeah, I think that you make a good point there because with the stock at all-time highs and the RSI overbought on a technical basis, they better hit every metric, beat every metric, and then raise guidance. I think we're going into one of those high bar type of events here for Broadcom, and I think that's the way that I looked at this, where you're taking advantage of vol dispersion between the option series for Broadcom going into these results with near-term implied volatility really elevated. So this strategy takes advantage of, if you think, hey, maybe it goes down that one standard deviation, this takes advantage of it. Going out to the June 13th weekly cycle, so just 8 days to expiration, we're going to buy the at-the-money 260 strike put. And then against it in the near term, June 6th weekly options expire in just 1 day. We're going to sell the 245 strike put. So a bearish $15 wide put diagonal to the downside, just about a week in duration on this one. You're going to pay roughly about a $7.30 debit. Maybe it's $7.50 right now. But that debit you pay is going to be the risk. It's $15 wide bearish put diagonal, but you're paying about half the width of that put diagonal. Why is that? Well, because you're buying a lower implied volatility of about 72% in the June 13th 260 strike puts and selling about 147% in that near-term option in the 245 put that you're selling on this one. Break even, anything about below about 257, 256 is going to be profitability on this one. But the lower price input on this bearish trade, maybe some consolidation, maybe a little bit of a pullback if they miss earnings. But don't do this. If you think the stock's going to go higher or kind of remain where it is, don't do this type of trade. Maybe do the call diagonal. But this is a bearish put diagonal, taking advantage of the volatility levels in the option series for that exposure to the downside.
Yeah, a couple things. Obviously, it's a time spread, right? It consists of two different expirations. You're never going to have a perfect break even, at least while it exists in that format.
Yeah.
Now, if for whatever reason you ended up going all the way to June 13th and you just had that put, easiest way to find the break even there is just simply take the debit away and you're looking at somewhere in the low 250s. The nice thing about this type of strategy, and the reason I think the diagonal sometimes is appealing over just the calendar, is the calendar has that mountaintop price risk profile where you can be bearish and the stock can collapse and you lose money because it overshot your target. As structured here, you take a little bit more risk, you spend a little bit more, but you insulate yourself from that tremendous, multi-standard deviation move where you had direction right. But you're still going to get paid even though maybe it overshot the 245 strike. So
and that's a good point about like the calendar, downside calendar around that 245 level. Say it goes and down to $220 or $225. That's where it starts losing money. This one, because you're paying less than half the width of the spread, anything below maybe about 257, 255 is going to be profitability on this one.
Yeah, well said, and takes a little bit more risk. But you're talking about a bigger name, and perhaps again, this can be something that if you are worried about earnings, you don't want to take off that longer term position. If you are a stock shareholder or whatever, maybe you heard Angelo say, hey, near term, it's a little extended. We like it long term, and that sets up. This can be complementary. So it doesn't have to be whole position bearish. It can just be a bearish earnings trade in complement to something longer term. Tom White, welcome back, and good look here at Broadcom, a name that certainly had a nice run over the last few years. Looking forward to the earnings event later on.